Assalamualaikum Prof and everyone. Today our group will be presenting on a case study of Nike Incorporations and JetBlue. I'm Aminatun from Group 4. Together with me here is Faidi, Nick, Afwan and Afa. Our group choose to present on a case study of Nike Incorporations. Okay, let me begin the presentations with some introductions and case overview. Okay, Nike was experiencing stagnations in which revenue persisted at almost 9 billions starting from 1997 to year 2001. Its earnings diminished and its market share in the US shoe sector fell from 48 to 42%. So management was really worried about this, and they identified the three obstacles that impeded the progress, which are supply chain disruptions. It means that there is delay in a new product launches. Next is that a robust dollar that weakened international revenues, and eventually on the competitors who attracted mid-tier consumers, while at the time Nike just targeted and focused on the premium markets. Okay, with these headwinds, management implemented 4-point strategies to get back on tracks and to ensure that the problems is fixed. Firstly, Nike want to relaunch a mid-price shoes, which the cost is ranges from $70 to $90. Next, that the Nike want to increase sales of the higher margin clothing lines. Third is that exercise the cost controls by reducing unimportant expenses, and fourth is spurring growth by 8 to 10% annually in sales and 15% in profits. Okay, with this, investors appreciated the aim but has concerns regarding implementations. So the spotlight investors like Kimi Ford. Kimi Ford is a portfolio manager from North Point Groups. So she said that she spot a Nike's price drop, but then she only can call it cheap and show her interest to buy if Nike can earn more than its cost of capital. So this means that Kimi and her assistants, Joanna Cohen's, drill down the value of the stocks by conducting calculations for weighted average cost of capital. So from there only she can spot whether Nike stocks is actually undervalued or overvalued, and eventually this will lead to her decision makings whether to buy or just to pass the investment with Nike. Okay, with that, I pass the presentations to my teammate, Faidi.
Assalamualaikum. I will briefly assess Joanna Cohen's WSEC calculation for Nike. Cohen estimated Nike's WSEC at 8.4% using a CAPM model for the cost of equity and interest expense ratios for the cost of debt. The assumption included a risk-free rate of 5.74% based on 20-year treasury yields, a market risk premium of 5.9% using the geometric average, a beta of 0.8 based on Nike's 5-year historical average, and book value weight of 27 debts and 73% equity. Next, I will talk about the key observation. While Cohen's framework was reasonable, several methodological flaws make the result unreliable. First, Cohen used book values for debt and equity instead of market values, which distorted the capital structure and likely understated the WACC. Second, she calculated Nike's cost of debt by dividing past interest expense by book debt. This backward-looking approach ignores Nike's publicly traded debt, which trading below par imply a higher market yield or cost of borrowing. Third, her beta estimate was simple 5-year average. However, Nike's beta had been declining, and using a more recent or industry average beta would be better reflect current business risk. Finally, Cohen applied a market risk premium of 5.9% based on geometric mean. In practice, the arithmetic mean, which closer to 7.5%, is typically used for forward-looking return expectation. This understated the cost of equity. I will pass to my teammate for the next slide. Thank you.
Okay, just now Faidi already shared with us the Cohen's WACC calculations, which derive at 8.4%. Indeed, the calculation made was based on the assumptions of book value instead of the market conditions. So therefore, we have to recalculate, and we will find a revised WACC rates here. Okay, let me explain. Based on the table here, on the left are the Joanna Cohen's assumptions, and on the right is the live market figures from 6 July 2001. So from here, we notice the three big gaps. The first one is on the risk-free rate. She used a 20 years treasury instead of 10 years. For debt cost, she indicated 4.3% instead of 7.17 investors demand today. And for capital structure weight, she used book value of 27% debt that understate equity risk compared with the market mix of 9.8% debt. So with this market alignment, inputs in hands, let's crunch the numbers and see how the WACC actually changes. Okay, from the slides here, you can see that this is a revised WACC calculations. We recalculate the rate based on the updated figures, which use the assumptions of the market conditions. Okay, first of all, we need to find the cost of equity based on the Kaplan model, and then followed by cost of debt, and then eventually we will get cost of equity RE of 10.19%, and the cost of debt, the RD is 4.59%. So this is how it is been calculated, and eventually we will plug in the weights into WACC formula. So at the end of it, we get 9.6% of revised WACC calculations. So it means it's a variance to the calculation made by Cohen's of 8.4%. Okay, for the next slides, we will see why we need to revise the WACC, and what actually matter for us to do the recalculations. Basically, the 9.6% is actually a minimum return Nike must earn on a new capital. So when we compare with Cohen's 8.4%, it knocks a few dollars of the DCF, but strips out wishful thinking. So it forces management to back on high return ideas, and for us as investors, it's a cleaner, more realistic risk gauge. So overall, we can put simply, Cohen's underestimated risk. Our 9.6% WACC reflects today's market, and even with the tougher rate, Nike still looks undervalued just by slimmer margins. So Overall, we can call it a qualified buy. Okay, with that, I pass the presentations to the next presenter.
Hai, Assalamualaikum warahmatullahi taala wabarakatuh. I am Ni Abdul Aziz bin Iman. I will continue the presentation with an analysis of Nike's cost of equity, focusing on two established valuation model, which are the capital asset pricing model (CAPM) and the dividend discounted model (DDM). The objective is to assess Nike's cost of equity in a way that supports a credible investment decision. Okay, let's deep dive into first approach, which is a capital asset pricing model (CAPM). Okay, using the CAPM formula, Nike's cost of equity is calculated at 9.88%. This is based on risk-free rate of 5.78% from the 20-year US Treasury, beta of 0.69, reflecting Nike recent market risk profile, and market risk premium of 6%. Okay, CAPM is a market-based model that captures systematic risk, making it strong candidate for valuation purpose. Next is a dividend discounted model (DDM). Based on the calculation, the dividend discounted model (DDM) provides a lower cost of equity at 6.71%. This result is driven by Nike's historical dividend of 0.48, a projected growth rate of 5.5%, and its market price of $42.09. However, the DDM approach is only consider dividends. This approach does not take into account for retained earning or reinvestment strategy. Okay, both critical for both retained earning and reinvestment strategy is critical for a growth-focused company like Nike. Comparing these two approaches, CAPM provide a risk-adjusted, market-driven estimate that align with Nike capital structure and growth strategy, while DDM is simpler, but it failed to capture the economic value created through retained earning and brand investment. For a company like Nike, with strong and brand equity, global expansion, and modest dividend, CAPM offer more accurate and decision-relevant measure in this case, in our opinion. To conclude this section, the CAPM base cost of equity at 9.88% should be preferred rate when evaluating Nike equity cash flow and overall valuation. The DDM output is not reflective of Nike's fundamental and leads to material undervaluation. For equity investor or portfolio manager, relying on CAPM ensures alignment with risk-adjusted market expectation and support a more robust investment thesis lah.
Okay, hi, my name is Puan and I'm going to explain to you two methods we use to estimate Nike cost of equity, which is we use two models, the capital asset pricing model or CAPM and the dividend discount model, we call it as a DDM. So let's start with the CAPM first. One of the good thing about CAPM is this method include market risk using a number called beta. Beta tell us how much the company stock move compared to the whole market. This makes CAPM useful for the company company like Nike, which are affected by the economy. CAPM also work well for the company that don't pay a big dividends, but instead of reinvest their profit to grow. But CAPM has some weakness. The beta value can change over time, which can make the result less reliable. Also, the CAPM assume market are perfect and all the investors are diversified, which isn't always true. And finally, it uses something called the market risk premium, which is an estimate and can be different depending on the who calculate it. So every person who calculate it maybe can get a different result. Now we'll talk about the DDM. The dividend discount model is simple and easy to use. It's look at how much dividend a company pays and how fast it's growing. DDM work best for the company that pay regular and stable dividends. It also gives more conservative results since it only looks at the money returned to the shareholder. However, DDM also have downside. It doesn't include things like reinvest profit or future growth, which can make growing companies like Nike look less valuable. It's also very sensitive, which is small change in the growth rate can change the result a lot. And if the company doesn't pay dividend regularly, DDM doesn't work well. In the conclusion, while both CAPM and DDM are useful, CAPM is better choice for Nike. That's because of Nike is a growth-oriented company. It's used a big part of its earning to expand the business, not just to pay the dividend. CAPM help us to understand the return investor expect by looking at the risk from the whole market and not just in the dividends. DDM is still helpful, but it's mostly for stable company that pay steady dividend. For a company like Nike, which focus on innovation, branding, and long-term expansion, DDM can miss big part of the picture. So choosing the right method depend on the company strategy. If the company is growing fast and reinvesting its profit like Nike, CAPM give a more realistic and complete estimate of the cost equity. Thank you for listening.
Assalamualaikum, Prof. Here is for investment recommendation for night. Through the valuation using the DCF method estimate, the instant value is 58.13, while the market price was just 42.09, which is it showed that 38% upside. So even when tested with the higher WACC value between 9% and 10.5%, NIKE remain undervalued. This showing the resilience across the different assumptions. Strategically, NIKE is aimed for 8 to 10% share sales growth and 50% earning growth beckoned by innovation, branding, and supply chain improvement. Financially, NIKE cost of equity via cap stand at 9.3%, and its strong fundamentals reinforce a long-term profitability. By giving this, keen thoughts as a portfolio manager should confidently recommend a buy on NIKE share. Is a sound fit for a value-focused and risk-aware investment strategy.
Okay, let us continue with presentations on the case study of JetBlue IPO. Before we deep dive into the presentations, let me start with the introductions and the case context. Okay, JetBlue started in 1999, founded by David Neelemans to make flying friendlier. And they save money by using only one plane model, which is the Airbus E320, which made maintenance and trainings easier. Okay, not only that, passengers still got small perks. For instance, they are providing with leather seats and free live TV without paying high prices. Okay, by April 2002, they had about 24 planes, 108 daily flights, and were still making profits even after the tough period following the 11 September attacks. So with that growth, they needed more cash to keep expanding, so they look at the going public through an IPO. Okay, on the case context, in April 2002, JetBlue applied to list on Nasdaq as JBlue, hoping to raise about $140 million. The money would pay for about 34 more A320 aircraft and let early investors sell some of their shares later. With that, bankers suggested a share price between $25 to $26, but however, demand was much higher than expected. With that, management now had a choice whether to raise the price to bring in more money or keep it lower so new investors could see some quick gains when they start trading. Okay, before going public, JetBlue asked, how does this help us? What are the benefits that we will enjoy by going public? So let us start with the main upside first. Okay, the first point is that on the capital injections, the IPO brings in about 140 million, which is enough to put deposits on the 34 new A320 aircrafts to cover everyday costs. The second point is that liquidity for insiders, which means after 6 months, founders, staff, and early investors can finally turn their papers into real cash. The third point is that brand on and credibility. A Nasdaq listing shows airports, lessors, and passengers that JetBlue is solid, and it gets analysts talking about the airlines. The fourth point shows that in terms of governance and cheaper debt, because public reporting tightens company controls and stronger balance sheets, which then can lower interest rates on the future loans. Lastly, on the strategic flexibility, for JetBlue, the tradable shares let them do small deals or rewards to the employees with stock instead of cash. Okay, let's move to the downsides of these plans, because good news always comes with caveats. After weighing the upside, JetBlue had to consider the flip side. What could go wrong if they step onto the public stage? The first point shows that dilutions and fees. When the selling's new shares shrinks, the founders slice and about 7% of the money raised goes back to the banker and listing fees. Second point is that market volatility. In terms of market volatility, airlines stock rise and falls with fuel price and world's event. So if the price drop, staff morale and future fundraisings can take a hit. On information leakage, it refers to the public filings, give rivals a look at JetBlue's cost and growth plans. This will make it easier for them to copy or compete in a long run. On the administrative burdens, such as the quarterly reports, strict rules, and non-stop analyst calls, pull managers away from day-to-day operations. And last but not least, is on the shareholder pressure. Public investors might push for quick profits, which can clash with JetBlue's long-term customer-first approach. So with that, I pass the presentations to the next presenter. Thank you.
Assalamualaikum Prof and everyone. Let's proceed with the evaluation. Under evaluation, we will discuss about using the three methods, which is first is discounted cash flow, second is comparable companies analysis, third is the market multiple method. So let's begin with the first evaluation method, the discounted cash flow or DCF approach. This method estimates the JetBlue interim value by forecasting its free cash flow from 2000 to 2006 and discounting them using a WACC of 9%. So the present value of this FCF total is 168.54 million. So next we calculated the terminal value using a 5% per 12 growth rate. So yielding 1.18 billion, which discount to 768.50 million. So the total enterprise value is about 895 million. Dividing this by the 47 for 45 million share result is an instant value share price of 18.86. So this method is ideal for high growth firm like JetBlue because it's focused on long-term cash flow potential. It's also worth noting that over 85% of JetBlue value stem from terminal growth, which reflects strong market confidence in its future. Next is the comparable company analysis. Here we benchmark JetBlue's against peer airlines using the EBITDA multiples. The industry average multiple is 6.1 and the JetBlue's 2001 EBITDA is 84.9 million. Multiplying these two given an enterprise value of 518 million. Dividing by the same share base, the estimated value per share is 10.62. This approach reflects how investors currently value similar companies and is often used to guide IPO pricing. While less forward-looking than DCF, it serves as a strong reality check grounded in the market sentiment. The third method is the market multiple approach. We apply the EV over revenue ratio using a 2.0 times industry multiples and the JetBlue revenue of the 320.5 million. So this given an enterprise value of 641 million or 13.51 per share. So this technique is especially useful for high growth firms that might not yet have consistent profit but are rapidly scaling their top line performance. It's a simple, quick and effective in the context of early stage of grow the company. So you can see that the JetBlue valuation range from 10.62 to 18.86 per share depending on the method. So the DPF methods offer the most comprehensive outlook, making it the preferred tool for the long-term investor. So however, all the three methods consistently indicate that JetBlue IPO price should reflect strong value potential.
Okay, I will continue on the financial forecast in JetBlue Airways IPO prospectus, which spans from 2001 to 2010. This forecast was critical in supporting the company's public offering in April 2002. Okay, let's look at the first point, which aircraft growth. JetBlue projected aggressive fleet growth, expanding from 21 aircraft in 2001 to 117 by 2010. This represents a compound annual growth rate of over 20%, signaling an ambitious expansion strategy. Success here would rely on access to capital, regulatory approval, and also a strong route development. Next, the company assumed a steady increase in revenue per aircraft, growing from 15.3 million to 24.9 million by 2010, which around 4% per year. This actually aligns with inflation and minor efficiency gain, suggesting confidence in their low fare, high service model targeting underserved market. Next, in terms of operating margin, JetBlue also forecasted a significant rise from 8.4% in 2001 to 15.2% by 2003. It's maintaining that level thereafter. While optimistic, this target is comparable to Southwest Airlines, indicating it's achievable with disciplined cost management and also scale efficiency. On the cost side, JetBlue used 5% of annual inflation rate for capital expenditure or CapEx, with aircraft price rising accordingly, which from 21 million to 33 million per airplane. Depreciation per aircraft also increases reasonably, reflecting standard asset life cycles. And last but not least, the company also kept their net working capital turnover ratio at 9.4, suggesting high operational efficiency, though it was underestimate the complexity of scaling and also apply a flat 34% tax rate consistent with US standard at the time. In overall, while JetBlue forecast is clearly ambitious, it is built on internally consistent industry-based assumption and also reflect a credible low-cost carrier strategy.
As we know, JetBlue is planning its IPO during a challenging time for the airline industry. Therefore, determining a suitable discount rate is critical to value its future cash flow accurately. Why the discount rate matters? The discount rate is a core input in the discounted cash flow valuation model, DCF. It allows us to convert JetBlue's projected future cash flow into a present value that reflects both time value of money and the risk associated with those cash flows. For JetBlue, getting the correct discount rate is crucial because it directly impacts the company valuation and determines whether the IPO price is reasonable or not. Okay, now let's move to how to estimate the cost of equity, CAPM. Okay, to estimate the cost of equity, we apply the capital asset pricing model, CAPM. In this model, we use three inputs lah. First is a risk-free rate, which we take as 5% based on long-term US Treasury yields. The second one is market risk premium, which is estimated at 5%, as stated in the case study. The third one is a beta, which measures how sensitive JetBlue stock would be compared to the overall market. Okay, in the case study for Southwest and an established low-cost airline has a beta of 1.1. However, JetBlue is still very young, less diversified, and operating during a post 9/11 crisis. So to reflect this higher risk, we assign JetBlue a slightly higher beta, 1.2. Okay, by using this three input, that give us cost of equity for JetBlue is about 11%. Okay, now let's continue with cost of debt and WACC. Based on comparable airline debt, we estimate a pre-tax cost of debt about 6.5%. After adjusting for the corporate tax rate of 34%, the after-tax cost of debt become around 4.29%. Okay, regarding capital structure, JetBlue balance sheet suggests a mix of 60% of equity and 40% of debt. Combining test components, we calculate the WACC at roughly 8.3%. From the weighted average cost of capital or WACC calculation, 8.3% might seem sufficient. However, using WACC of 10% is more suitable in JetBlue case for several reasons. First, JetBlue is still in an early stage company with limited historical performance. Okay. Secondly, the airline industry remain highly volatile, especially just months after the 9/11 attacks. Okay. And the third one, future growth is aggressive and dependent on many assumptions, which add execution risk. Therefore, using 10% as a discount rate adds a conservative buffer that better reflect the risk associated with the company's projection.
Okay guys, so let me explain why we recommend JetBlue to offer the IPO share at $26 per share, which is the highest price in the new range. First for all, there was very strong demand from investors. Even after they raised the pricing range from $22-24 to $25-26, many people still wanted to buy. This shows that the market is very interested and the JetBlue can safely go with the top price of $26. Second, JetBlue is doing very well financially. Even JetBlue is a very young company. In 2001, they make a profit of 38.5 million and they are expected to make more in the next few years. This is much better than many company airlines at that time. Third, JetBlue has a clear growth plan. They are adding more airplanes and new routes. Their revenue is expected to grow from 320 million to nearly 3 billion by 2010. That is a big sign of future success. Also, many experts and analysts like JetBlue a lot. One even said it's as a close to sure thing as it gets. That thing kind of positive feedback means people believe in that company. By choosing $26 per share, JetBlue can raise more money to support its growth while still giving a new investor a chance to earn profit in the future. This price shows confidence but also keep the offering attractive. In conclusion, $26 is a fair and smart price. It reflects JetBlue's strong business, growing future and the trust from the investor. This price will help the IPO success and support JetBlue in the long term. Thank you very much for listening.